Welcome to the next module, Understanding Financial Statements. These documents may look intimidating at first, but they're really just stories about a business, told in numbers. In this module, we'll explore financial statements, where they come from, what the numbers say in some common terms which will help us understand the flow and show how a business is really doing. Let's begin. What are financial statements? Think of them as a company's report card. They tell you how the business is performing, what it earns, spends, owns, and owes. The three key statements are profit and loss statement, balance sheet, and cash flow statement. Every financial story begins with a simple action, a transaction. For example, buying supplies, making a sale, or paying salaries. Each transaction then gets recorded in the language of money in a business diary called journal. Then, these journal entries are sorted into a ledger, grouping similar items together, like all your sales in one place, all your expenses in another. Next, we prepare a trial balance. A checkpoint to make sure every debit has a credit and the books are balanced. And finally, from this sorted, organized data, we create the big picture reports, your financial statements. You might be wondering, where do all these numbers in financial statements actually come from? They come from the day-to-day transactions happening across the business. How it all flows together, these individual transactions are first recorded in the journal, then sorted into the ledger, balanced in the trial balance, and finally appear as totals in the financial statements, as the profit and loss statement, balance sheet, and cash flow statement. This forms the basis of financial statements, and this entire process is called bookkeeping. Let's now explore some common accounting terms to help us better understand financial statements. What is a journal? A journal is the first place where financial transactions are recorded in a business. Think of it as a daily diary of money activity. Every time money comes in or goes out, it gets written down in the journal first. What is a general ledger? A general ledger, often just called the ledger, is the main book of accounts where all financial transactions are grouped and organized. It collects information from the journal and organizes it into individual accounts like sales, rent, salaries, electricity, bank account, cash account. What is a chart of accounts? The chart of accounts is like the shelf labels in a supermarket. Everything is sorted so you can find what you need quickly. Think of it as the index for all financial transactions. It organizes every account a company uses to record transactions. Each account has a unique name and number for easy tracking. It keeps financial data organized and easy to read. What is debit and credit? Debit and credit are the two sides of every financial transaction in the double-entry accounting system. Every time something is bought, sold, paid, or earned, one account is debited and another is credited. For every debit, there's an equal credit. This keeps the books balanced. Think of it like a seesaw. If one side goes up, debit, the other side, credit, goes down by the same amount to stay balanced. What is a trial balance? A trial balance is a summary list of all accounts from the general ledger, showing the debit and credit balances. It's used to verify that the accounting entries are mathematically accurate. If total debits equals total credits, the books are balanced. Think of a trial balance as a quick financial health check, ensuring everything adds up before you proceed to the final report. So far, you've learned how financial data begins, but the question is, where does all this lead to? The final destination is where the real financial story of a company is told, through the main financial statements. These are the reports that help you answer questions like, are we making a profit or a loss? What do we own, and what do we owe? Where is our cash coming from and where is it going? Now, let's understand the three main financial statements: the profit and loss statement, the balance sheet, and the cash flow statement. What is a profit and loss statement? It answers the question, how much did we earn or lose? Also called the income statement, this shows a company's revenue, expenses, and profit or loss over a period of time. We can prepare it monthly, quarterly, or yearly. What does it include? It includes revenue, that is sales or income earned, expenses, that is costs like salaries, rent, utilities, and net profit or loss, that is what's left after all expenses. If your income is more than your expenses, then your business is in profit. If your expenses are more than your income, then your business is in loss. Why does it matter? This statement tells you how well the business is performing. Let's now go over some simple definitions of the key items you'll find in a profit and loss statement. What is revenue? It is the income earned from selling goods or services. What is cost of goods sold? It is the direct costs of producing the goods or services sold. What is gross profit? Gross profit is the profit a business makes after subtracting the cost of making or buying the products it sells. It is calculated as revenue minus the cost of goods sold. What are operating expenses? They are the day-to-day running costs like rent, salaries, marketing, and the like. What is net profit? It is the final profit after all expenses are deducted. What is other income? It is the income from non-core activities like interest, rent, dividend. What is depreciation? Depreciation is the gradual reduction in the value of an asset over time due to wear and tear, aging, or obsolescence. What is EBITDA? EBITDA means earnings before interest, tax, depreciation, and amortization. It shows how much profit a company makes from its core operations before considering financial costs, like interest, tax payments, or non-cash expenses, like depreciation. Now that we've understood the profit and loss statement, let's move on to the next key financial report, the balance sheet. It answers the question, what do we own and what do we owe? It includes assets, that is, what the company owns like cash, buildings, inventory. Liabilities, that is what the company owes like loans, bills, debts, and equity, that is what's left for owners after debts are paid. The balance sheet is based on a simple rule: both sides must always be equal. On one side, you list everything the business owns, called assets. On the other, you list what the business owes, liabilities, and what's left for the owner, equity. The total of assets will always equal the total of liabilities plus equity. Why does it matter? It shows how stable and secure the business is financially. Now, let's go over some simple definitions of the key items you'll find in a balance sheet. What is an asset? An asset is the resource a business owns that has value and can help it earn money or run its operations. Like cash, equipment, inventory, or even money others owe to you. What is a liability? A liability is what the business owes to others. This includes money you need to pay back, like loans, unpaid bills, or supplier dues. What is equity? Equity is what belongs to the owner after paying off all liabilities. It's the owner's share in the business, also called owner's capital. What are account receivable? It is money that others owe your business. These are customer payments you're waiting to receive. What is inventory? Inventories are goods or materials that the business has on hand to sell or use. What is accounts payable? It is the money that the business owes to others. Usually, they are unpaid bills to suppliers. What are fixed assets? They are long-term items that the business uses to operate its business. These items are not for sale. They are also called non-current assets. Examples are equipment or buildings. What are current assets? Assets that can be turned into cash within a year are called current assets. This includes cash, inventory, and accounts receivable. What are current liabilities? Debts or obligations due within a year are called current liabilities. This includes bills, short-term loans, or payments to suppliers. Now that we've understood the balance sheet, let's move on to the third key financial statement, the cash flow statement. While the P&L tells us about profits and the balance sheet shows what we own and owe, the cash flow statement answers a crucial question: where did the money actually go? What is a cash flow statement? It asks the question, where is the money actually going? This statement tracks the actual movement of cash in and out of the business. It includes operating activities, that is cash from daily business like sales or expenses, investing activities, that is buying or selling equipment, property, and financing activities, that is loans, repayments, dividends. Even a profitable business can run out of cash. This report shows if the business has enough cash to keep going. Why does it matter? It helps track liquidity and the company's ability to pay bills and stay afloat. Let's go over some simple definitions of the key items you'll find in a cash flow statement. What are operating activities? Operating activities are the day-to-day activities that generate income or require spending. What are financing activities? They are activities related to raising money or paying it back. What are investing activities? Buying or selling long-term assets used in the business are called investing activities. What is cash inflow? Money coming into the business is called cash inflow. What is cash outflow? Money going out of the business is called cash outflow. What is net cash flow? The difference between total inflows and outflows gives us the net cash flow. What are capital expenditures? Money spent on buying or upgrading fixed assets that last a long time is capital expenditure. What is working capital? The money available for day-to-day operations is known as working capital. The formula for calculating working capital is current assets minus current liabilities. Even if you're not in finance, knowing this helps you understand how your work affects the business, spot budget issues, read reports without confusion, and make smarter, cost-aware decisions. For example, you're a team leader and you overspend on training. The profit and loss statement will reflect higher expenses. Say, you're in marketing and you delay a campaign. This affects revenue in the next quarter. You're in HR and you hire too fast without acknowledging the budget. The cash flow may become tight. Understanding finance helps you make better and informed decisions. Alright, you can quickly go over what we've learned. That's a quick recap of what we've covered. Thank you for joining me, and I'll see you in the next module.